Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories within company filings. And today it seems like Mitesco Inc. has been busy issuing shares like they're giving out party favors. Get ready because we are diving deep into Mitesco Inc.'s latest report, and it is a real mixed bag of stock issuances and financial maneuvering that we need to decode. Before we jump in, if you love getting these kinds of unfiltered insights into corporate actions, make sure you hit that subscribe button. And hey, we have a fantastic community over on our Discord server, linked down below, to discuss all things finance. Alright, let's get straight to it. This is an 8K filing, which means something significant happened that the company needs to tell the public about right away. And what happened? Mostly it is about the company issuing new stock, which is a big deal for shareholders. So, the first big item here is about the company selling what they call unregistered equity securities. Basically, they sold stock in deals that were not open to the general public using a specific exemption under the US Securities Act. This is often done to raise capital quickly from institutional investors. Now, let's talk about the Series X preferred stock. The company has quite a bit of this, with a total face value of over $1 million. This stock pays a dividend, which is like interest at a 10% annual rate. What is interesting here is how they paid some of these dividends. Instead of using cash, they issued restricted common stock. This means they gave out newly created shares of their regular stock. For the third quarter of their fiscal year 2025, they issued almost 100,000 shares of this restricted common stock to pay dividends. They break down who got what, with specific investors like Anglo-Irish receiving a sizable chunk of over 70,000 shares. This is a common strategy when cash is a bit tight, but it does dilute the ownership percentage of existing shareholders. Every new share means everyone else owns a slightly smaller piece of the company. Next up, we have the series of preferred stock redemptions. This sounds a bit more complicated. The company had issued this series of preferred stock as part of a restructuring. Think of it as a debt that was converted into a special kind of stock. The key feature here is that it is supposed to be redeemed, meaning paid back over time. The company is paying back this series of preferred stock either with cash or with common stock. When they use common stock, it is at a discount to the market price. This is another move that can dilute existing shareholders. The company has issued a massive 2 million shares just to redeem about $250,000 of this series of preferred stock. We see further reductions from allowable issuances to stay under a certain ownership limit, like with GS Capital and AJB, suggesting these investors are also trying to manage their stake in the company. The remaining value of this series of preferred stock is still over $13 million, and the company is apparently in talks to change or even eliminate it. This suggests ongoing financial restructuring and a potential shift in how they manage their obligations. Then we have the issuances to the software development team. The company gave out another 725,000 shares of restricted stock to consultants working on their robo-agent software. This is pretty standard practice to incentivize key personnel, especially in tech roles. They mentioned that about 200,000 of these shares were already disclosed to their new chief technology officer. This is on top of other compensation, meaning these key employees are getting a mix of cash and ownership. Again, more shares being issued means existing shareholders own a smaller piece. So, after all these issuances, the total number of shares outstanding is now around 14.6 million. Think about it, less than a year ago, the company had around 6.8 million shares outstanding. They've essentially more than doubled the number of shares in circulation through these various stock issuances. Under other events, they mention issuing a press release on the 18th of September about expansion plans and future events. We assume that press release filed as an exhibit gives more color on what they are planning. And finally, the exhibit section just lists that press release and the interactive data file. Now here is my take on all of this. Mitesco Inc. is clearly in a phase of significant growth or restructuring, characterized by heavy reliance on issuing stock. While issuing stock can be a valid way to raise capital and incentivize teams, the sheer volume of shares issued here is a major red flag for existing shareholders. They've effectively doubled the share count in what seems like a short period, meaning your ownership percentage is getting significantly diluted with each of these transactions. The constant stream of preferred stock redemptions and issuances, especially when done with stock, signals that the company is likely managing cash flow carefully, potentially not generating enough from operations to cover all its obligations. The flexibility to issue stock in lieu of cash for dividends and redemptions shows they're using every tool available, but it comes at the cost of shareholder value dilution. The company's direction seems to be heavily focused on software development, specifically the robo-agent The issuance of stock to the development team is a positive sign that they are investing in key talent for this venture. However, the ongoing restructuring and the uncertainty around the series of preferred stock also point to potential financial challenges or a complex capital structure that is being worked out. The biggest risk here is continued dilution. If the company keeps issuing shares at this pace without a corresponding significant increase in profitable revenue or, better yet, positive cash flow from operations, the value of each existing share will likely continue to decrease. Opportunities lie in the success of their software development projects, especially the robo-agent, which could eventually drive revenue and reduce the need for these dilutive financing methods. In conclusion, Mitesco Inc. is a company undergoing significant financial and operational adjustments. While there are strategic moves being made, particularly in software development, the aggressive share issuance strategy poses a substantial risk to current shareholders due to dilution. Investors should watch closely to see if the company can translate these investments into profitable growth that can support its valuation without further diluting equity. What is your take on these rapid share issuances? Do you think Mitesco Inc. is making the right moves to grow, or are they just diluting shareholders into oblivion? Let me know in the comments below. If you found this breakdown helpful, please give this video a thumbs up. It really helps the channel, and if you haven't already, subscribe for more deciphered corporate filings. Don't forget to join our Discord community, linked in the description, to keep the conversation going. Thanks for watching, and I'll see you in the next Decode.